Namaste, candidates. Welcome to this session on credit value at risk or credit VAR. Sometimes we tend to call it credit VaR. Now, this credit VAR is one of the most important links between market risk and credit risk. So, in this lecture, we'll understand how this credit VAR extends the traditional concept of VAR beyond price movements so that we can quantify the uncertainty arising from credit quality changes, downgrades, and of course, even defaults. Now we'll see some models like CreditRisk Plus, the Vasicek model, CreditMetrics, how these models frame credit losses, and in that process, how they help the banks estimate portfolio level capital requirements and tail risk exposures. So by the end of this session, you should have a decent understanding of how Credit VAR connects portfolio risk modeling with real world capital planning and regulatory frameworks. So let's get started. Now let's start by clarifying what do we mean by Credit VAR. Now, most of us are already familiar with market VAR. Okay, so let's just do a comparison of the definitions. So market VAR, it measures the maximum loss in market value over a set period that will not be exceeded with a certain confidence level. Okay, and it is mainly focused on what kind of losses? Losses due to changes in market variables like stock prices, interest rates, and foreign exchange rates. Now, credit VAR uses the same statistical idea. So it is similar, okay, maximum loss at a given confidence level which will not be exceeded, but the source is different. So here we are concerned with credit related events. Okay, so not only outright defaults, but also downgrades or even changes in credit spreads. All of these will reduce the value of loans or bonds. Okay, so in short, you can say that market VAR, market risk VAR is about volatility in prices, whereas credit risk VAR or credit VAR is about deterioration in credit quality. Now let's talk about why credit VAR really matters. So at its core, credit VAR captures the process of credit deterioration or the fundamental credit deterioration process that builds over extended periods of time. And this makes it a very essential tool for long-term portfolio management and regulatory capital allocation. Now, some points we need to address over here. The first point is that the credit deterioration process, okay, this credit risk itself, it unfolds quite slowly because we know that defaults and downgrades, they don't happen overnight. They actually build over months or even years. That is why credit VAR is measured over a much long term horizon, typically 1 year, unlike market VAR, which is measured on a daily basis in general. Okay, so exam may ask you a question where why credit VAR uses a 1 year horizon instead of 1 day horizon like market VAR. Okay, so you can answer this. Next, credit events have a systemic dimension. So one default or a wave of downgrades, they can spread contagion across markets and institutions because of how interconnected the financial system is. And the third point, which is important, is regulatory capital. From a regulatory capital perspective, credit VAR is central. Under the Basel frameworks, banks are required to calculate credit risk capital. In fact, you'll see later on that the Vasicek model, it provides the foundations for the internal ratings based approach. So in summary, credit VAR matters because it looks at the long term horizon, it captures systemic impact, and it is embedded in regulatory capital rules. Now let's compare market VAR and credit VAR side by side, feature by feature. So first feature we'll address is the time horizon. Now market VAR is typically 1 day, sometimes 10 days. On the other hand, credit VAR usually takes a 1 year horizon. Next, risk drivers, the drivers of risk. Now, market VR is all about price movements, interest rates, uh, foreign exchange, equity prices, whereas credit VR is driven by credit specific factors, like defaults, downgrades, spread widening. Third, look at the asset base. Market VR is measured on highly liquid securities. Okay, mostly instruments that trade on a daily basis. Credit VR applies to loans and bonds, which are often less liquid and not uh, mark to market as frequently. Fourth, reactivity. Market risk can change instantly and you can quickly hedge or rebalance. But credit risk is actually structural, it evolves slowly as discussed. And because of that, adjustments are much harder to make once the deterioration begins. Then the fifth feature is data frequency. So, market VR is about fast moving liquid markets, as we discussed. So, market VR uses daily or even intraday price data. Credit VR often works with monthly or quarterly data, which reflects the slower movement of credit quality. Okay, as we discussed, one of the key features of credit VAR is that it is almost always measured over a 1 year time horizon. Okay, let's see why that standard is used. So, the first reason is the timeline, the process of credit quality change. It takes time. Okay, unlike market prices, which move in seconds, this process of credit quality change, it actually builds gradually, as we have seen earlier. So that is why this 1 year time horizon is much more realistic for capturing the risks of defaults or downgrades, okay, or spreads widening, all those things. Next is regulatory alignment. See, regulatory capital frameworks like Basel, they have also standardized this 1 year measurement horizon for credit risk. Okay, this keeps the capital requirements consistent across banks, across jurisdictions, across financial institutions. And then another reason is business planning. See, we know that business cycles align themselves, say, generally every year with 1 year. So banks budget, they allocate capital and do strategic planning on an annual basis. So that is why using a 1 year horizon, it fits naturally into those credit decision making processes. Okay, so this 1 year standard is not just arbitrary. Okay, it reflects how this credit risk unfolds gradually, how regulators enforce capital requirements, and how banks themselves plan their operations. Okay, now let us move on to a concept which we have discussed multiple times in FRM part 1 also, rating transition matrices. This is a fundamental input to these credit VAR models. So let us see first the historical foundations. These matrices are based on historical data, either from a bank's internal ratings or from external rating agencies like Moody's, S&P, Fitch, etc. So they capture how ratings have moved in the past. Then time period. Okay, if you take an example, S&P publishes 1 year transition matrices based on decades of data, which track how ratings have changed historically, say from 1981 to 2020. This is the same data that we'll use for the rating transition matrices in this chapter. Next, probability tracking. So what do these matrices show? They show probabilities of upgrades, downgrades, and defaults within a 1 year window. Okay. So in short, these transition matrices are an essential tool for calculating VAR because they provide the transition probabilities that feed directly into the loss distribution models. So here we see this actual 1 year transition matrix from S&P based on historical data from 1981 to 2020. The probabilities are expressed as percentages. So how to read this matrix? So this first column is the column for your initial rating, and then you look across the rows to see the probability of ending the year in each possible rating bucket, including default. So for example, if you say look at an A rated firm, around 92.61% stayed A on the same rating over 1 year. 5.23% fell to triple B, and about, you can say, 1.67% were upgraded to double A. A very tiny fraction, 0.05%, defaulted. Okay. So even for investment grade companies, if you see, you know that the investment grade issues are from triple A to triple B. This is the line that demarcates the investment grades and speculative grade bonds. So you can see for the investment grade bonds also, even though the probability of default is very, very low, is still it's not zero. At least there is some probability, okay, very small probability. Okay, and of course, for if you look at speculative bonds, say if you look at this extreme, the triple C one, only about 51% stayed in the triple C category. So you can see if you analyze these diagonal elements, the percentage of these diagonal elements is the highest, of course, among all the cells, okay, across rows and columns. But even in these diagonal elements, as you are moving towards speculative grade, you are seeing that the probability of maintaining the same rating for these triple C rated bonds is actually lower, much lower, as compared to the probability of maintaining the same rating for a A rated bond. Okay, so this shows that these low rated credits are extremely fragile. Okay, so overall you can see that the transition matrices, they let us quantify how these uh, ratings are likely to change or say to default over a 1 year horizon. So in the exam, I think you can be ready to explain how to interpret, say, any row of a matrix or any cell of a matrix. Okay. Yeah, that's it. I think you all already are familiar with this idea from part one. So we have just repeated it. Let's move on to the next slide. Okay, so far we have looked at 1 year transition matrices. But what if we need probabilities for longer or shorter horizons? That is where multi-period transitions they come into picture. Okay, so let's see for longer periods first. For longer periods, you multiply the 1 year matrix by itself. Okay, so for example, suppose an A rated firm that we discussed just now, it had a 92.61% chance, right, of staying A rated in 1 year. If you want to extend that to 4 years, you just raise that probability to the fourth power. You will find that the result is 73.24%. Okay. So basically what we did, we raised 0.9261 to the power of 4. We got 0.7324, which is 73.24% over a 4 year horizon. Okay. Now for shorter periods, you simply take the fractional roots or the roots of the matrix. So again, let's discuss the same A rated firm, which was having a 92.61% 1 year stability probability, okay, of staying A only after 1 year. And if you want to find out the 3 month probability, we'll have to take the fourth root of that, because 3 months is uh, 1/4 years, right? So that's why we'll have to take the fourth root, or we'll have to raise it to the power of 1/4. So that comes to be around 98.13% for 3 months. Okay. So 0.9261 raised to the power 0.25 or 1/4 is 0.9813 or 98.13%. Okay. So if you see the summary for longer time periods, the default probabilities will actually increase, and the probability of maintaining the same rating, or the stability probability, you can say, it actually decreases. Whereas for shorter time periods, the default probabilities actually shrink, whereas stability increases. Okay. Now, one important limitation that we need to address is that these matrices assume independence across time. So in other words, they assume what happens this year has no effect on next year. But in reality, in the real world, you have something called as the rating momentum phenomenon, which we'll see in the next slide. Okay, so that is completely ignored by the calculations that we are seeing, because we are assuming independence. Okay, so multi-period transition matrices are extremely useful. Okay, because they allow us to calculate for longer periods as well as shorter periods. But remember, this independence assumption, okay, is actually uh, not completely true in the real world, because the real world actually, and this is where I should say the real world diverges from the models. Okay. Now let us see the ratings momentum phenomenon in the next slide. Okay. So now let's talk about this real world nuance that standard credit models often overlook: ratings momentum phenomenon. Okay. First, a quick reality check. In practice, when a company gets downgraded today, it is not an isolated event. Okay. That downgrade significantly increases the likelihood of another downgrade in the near future. So it's a reflection of underlying credit deterioration, because once it starts, it tends to, you can say, gain momentum, just like these, dominoes that you are seeing over here. So this happens because credit risk does not reset every period. It actually compounds. Financial stress, liquidity strain, or even loss of market confidence, all these things can reinforce each other, which leads to a cluster of downgrades rather than random downgrades. Okay. So because of this, rating momentum effects are created. Now, as we discussed, the model limitation, the standard transition matrices, whether we use them in the CreditMetrics model or other models, similar frameworks, these assume that each period is independent. Okay, so they assume that the probability of downgrade next month does not depend on what happened this month. And that is clearly unrealistic in many credit cycles. Still, despite this limitation, these models remain widely used because they are, simple, transparent, and supported by a lot of data which is available. So while they may not fully capture the momentum effects, they still provide a useful approximation. Okay, as long as we are aware of what they are missing. Okay, the big three models. So when it comes to credit VAR, three models dominate the landscape. Each model has its own approach, you can say own strengths, own weaknesses. So let's see which models we are talking about. The first one is the Vasicek model. Now, this model is the foundation of the Basel internal ratings based approach. We discussed this in FRM part 1 also. It calculates the worst case default rate, WCDR, the same WCDR that we discussed in FRM part 1, by linking defaults to systematic risk factors. Okay. So you can think of it as a probability driven model that regulators use quite heavily. Then you have credit risk plus. Now, this is more actuarial in style. Okay, it uses a Poisson distribution approach, and we'll see the details, of course, subsequently in the later slides. Okay, much like insurance claims modeling. Okay, it is quite efficient. It works well for large portfolios, and it provides a good trade-off. I'll say a good balance between the Vasicek and CreditMetrics. The third one, CreditMetrics. So this is the most comprehensive of the three. It does not just look at defaults. It also looks at credit ratings migrations, okay, and their mark-to-market valuation impact. So it relies on Monte Carlo simulation to capture the full loss distribution. So Vasicek is a regulatory, credit risk plus is actuarial and efficient, and CreditMetrics is comprehensive but highly data intensive. That's why I said credit risk plus gives a decent balance. But together, these three models, they form the toolkit for modeling credit VAR. Now let's unpack the Vasicek model. So the first building block is the inputs. We need the probability of default, which comes from credit ratings or internal estimates, and we need asset correlation, rho. Okay. Then what is the core output? From these inputs, the Vasicek produces the worst case default rate, okay, which is the maximum proportion of the portfolio expected to default under stressed conditions at a particular chosen confidence level. And this is the formula which ties everything together. Now, the math may look heavy, but for the exam, focus less on deriving it, although we have done this in FRM part 1 also, even the derivation part, the logical derivation, and the intuition also we discussed in FRM part 1. But still, from the point of view of the exam, you should focus less on deriving it and more on knowing the inputs and the interpretation of the output. So basically what we are seeing, it takes PD and correlation as inputs, PD and correlation. Okay. And it gives us the worst case default estimate. Okay. Now, how it is applied. Okay. So we start with one loan. Individual loss is calculated as WCDR times exposure at default times loss given default. This is the building block at the individual level. Then we have the portfolio level. So to scale this up, we sum across the individual loans in the portfolio, which gives us a portfolio wide loss distribution under the worst case stress conditions. And this is where the Basel comes in. The Vasicek model, as we discussed, it underpins the Basel internal ratings based or IRB capital requirements, the calculations for credit risk. Now, for a 1 year horizon at 99.9% confidence, the banks must hold capital against these worst case losses. And Basel also includes the maturity adjustment factor to reflect the maturity of the exposures, or you can say tenor of the exposures. So in the exam, if you see 99.9% confidence and 1 year horizon, most probably that is the Basel's use of the Vasicek framework. Okay, now correlation factor. Now see, the model uses asset correlations between the companies, but this asset correlation between any two companies is typically approximated by the equity return correlation between the two companies. Okay, and it is applicable for all the pairs of companies. Okay, so this correlation is what links defaults together in a portfolio. Now, since this row is hard to observe directly, they are approximated using this average equity correlation. And also, if suppose data is not available, they may even proxy using similar publicly traded firms. Okay. So Vasicek model, it moves from individual exposures to portfolio aggregation to Basel regulatory capital. With correlation, you can say it acts as the glue that connects the default across different firms. Finally, let's look at the limitations of the Vasicek model and the alternatives that are used in practice. So first limitation is tail correlation issues. So the Gaussian copula approach that is used by the Vasicek model, it incorporates very little tail correlation. Okay, so they exhibit thin tails, which means that the tendency to for extreme events to occur simultaneously is low. Okay, so insufficient probability is assigned to extreme joint movements. Okay, and that is why you have limited capture of tail dependencies. Now, of course, there will be practical impact of this. Now, during financial crisis, as we all know, default correlations, they tend to increase substantially above normal levels. Okay, so the Gaussian copula's inability to capture this phenomenon can lead to underestimation of risk in these extreme conditions. Okay, and of course, if you see carefully, this is the time when it matters the most for capital adequacy. The risks should be estimated as precisely as possible in these times. But in these times specifically, if the model is not capturing this phenomenon properly, okay, when it is mattering the most, then of course, somewhere down the line, the model is not effective in these conditions. Okay, so they are underestimating the capital requirements because they are not able to estimate precisely the tail risk. So what are the alternative solutions? You have different types of copulas that practitioners use. Okay, different types of dependence structures beyond the Gaussian assumption, which helps model the clustering of defaults in the tail in a better manner. Okay, so Vasicek model is definitely it's simple and regulator friendly, but there is a trade-off: weaker tail risk modeling, and you have alternatives which can improve, say, realism to some extent, but definitely they will add complexity, right? Now let us look at the credit risk plus model, which was developed by Credit Suisse Financial Products in 1997. Now, unlike uh, correlation-based frameworks, uh, one of them being the Vasicek model, credit risk plus actually takes the actuarial approach. Okay, it borrows ideas straight from the insurance industry. So it focuses on the frequency of defaults rather than their market timing or even market impact, I'll say. Okay, so you can think of it like modeling insurance claims. We are not predicting when each default is happening, but how many defaults over a given period. Now, this makes the model simpler, but still powerful enough for estimating aggregate credit losses. Second, the probability distribution. Now, defaults are treated as random variables following a Poisson distribution, which captures the randomness of default events. But there are some adjustments. See, since real world credit risk fluctuates with economy, credit risk plus allows the default intensity to vary, which we'll see in the next slide. Okay, we'll see the occurrence of uh, the negative binomial distribution also because of this, because of the default clustering idea. Anyways, next, the portfolio segmentation feature. Credit risk plus allows a portfolio to be divided into multiple risk segments, and that is why it accommodates varying risk levels, okay, across different loan segments. Okay, so you can take examples like you have corporate exposure, you have retail exposure, you can have sovereign exposure, and each exposure will have its own default rate and volatility. So this segmentation makes the model more flexible and more realistic for large diversified loan books. Okay, so credit risk plus in short is actuarial, Poisson based and segment driven. Now, what are the key assumptions that we have in credit risk plus? So we have highlighted the assumptions in brief, and some of those assumptions will again be repeated when we see the mathematical framework. See, the default probabilities are assumed to be very small. Portfolio is assumed to be large and granular, which is again quite a realistic assumption. Defaults follow a Poisson process. Default rate uncertainty follows gamma distribution, and recovery rates are deterministic. So with these assumptions in mind, let us see the mathematical framework of credit risk plus. Okay. So let's start with the binomial distribution. So portfolio, if you are having a portfolio of n loans, each having a default probability of q. The number of defaults m, it follows a binomial process. Okay. So this nm in the bracket, it is nothing but NCM, the same NCM that we have done in FRM part 1 probability chapter. Q to the power m, 1 minus q to the power n minus 1. So if you remember, this is the exact same formula from FRM part 1. So the binomial distribution formula, right? Now this simply gives you the probability of exactly m defaults occurring out of n loans. Okay. Next, the Poisson approximation. So when the default probability Q, we have assumed it to be small, right? So, and of course, in real world, it is small. We have seen the rating transition matrix also. Overall, the default column was having very small percentage numbers, right? So if Q is small and N is large, the number of loans, which is again quite typical in credit portfolios, the binomial distribution can be approximated by a Poisson distribution. Okay, so here lambda is equal to Qn is the, or it represents the expected number of defaults. So again, the probability of m defaults can be approximated as e raised to the power minus Qn or lambda multiplied by lambda raised to the power m divided by m factorial. Okay, so this Poisson simplification, it, you can say, it makes the model more tractable for large portfolios. Now, as I said earlier in the previous slide, uncertainty. There is some adjustment for uncertainty. So the adjustment is the gamma distribution. See, the default rates are not constant. They vary year by year due to economic cycles. So to capture that uncertainty, credit risk plus assumes that this lambda or the expected number of defaults actually follows a gamma distribution. So this is not constant. Okay. So this gamma layer actually, this gamma layer, you can say it allows the model to reflect changing conditions, to reflect the uncertainties. And because of this uncertainty, a default correlation, you can say, is induced across borrowers. Okay, see, in the pure Poisson setup, defaults were independent, and that is what binomial distribution also assumes, independence. But in this case, because we are assuming that this lambda follows a gamma distribution and there is uncertainty, it is not constant. So because of this uncertainty in lambda, we are able to induce a default correlation across borrowers. Okay. Now, if you combine a Poisson for defaults with a gamma distributed uncertainty for lambda, you end up with a negative binomial result or a negative binomial distribution. Okay. It gives you a closed form solution which captures realistic fat tail behavior, which means that in this case, with this negative binomial distribution, you will have higher probabilities of extreme loss events, just like we observe in real credit data. Okay, so to summarize, credit risk plus, it begins with binomial model of defaults, simplifies it with a Poisson approximation, adds macroeconomic uncertainty through a gamma distribution, and ends up with a negative binomial distribution which better reflects real world credit loss behavior. So it's quite elegant, it's analytical, and it is designed for portfolio level risk estimation. Okay, now that we have seen the mathematical structure of Credit Risk Plus, let us explore how it handles correlation and value at risk modeling. And then we look at some modern extensions that make the model more dynamic. So let's see the original framework first. Now, credit risk begins by recognizing that the default rates are not fixed, they vary year by year, and this uncertainty is quite essential because without this, the defaults would be independent and large loss events would be almost impossible to observe. Next, default correlation. Now, once we introduce the the uncertainty in default rates, we automatically create default correlation. So firms which are exposed to the same economic environment, they share similar exposures, and that's why their default probabilities move together. A credit risk plus uses Monte Carlo simulation to repeatedly simulate the default process and construct a loss distribution. And then the VAR or value at risk, typically at the 99.9% confidence level, is calculated to estimate extreme credit losses. Now, this loss distribution, if suppose correlation was not there, then it would be symmetrical. The correlation makes the loss distribution asymmetrical or positively skewed with fat tails. Okay, so which means that the probability of large losses increases, which matches the real world portfolio behavior. Then let us just see some enhancements. As we discussed, we'll also observe or we'll also discuss some of the modern enhancements to the Credit Risk Plus. So the first one is time series dynamics, time series consideration. See, historical data shows something more. It shows that default rates show serial correlation. So this year's rate depends on last year's. Okay. Earlier we were discussing, right? When we discussed the Vasicek model, there was an issue, right? Defaults were assumed to be independent of each other. Okay. But really, in reality, default rates show serial correlation. So to capture that, we can use auto-regressive models. Again, something from the valuation and risk models module in FRM part 1 must have struck over here because we used a lot of auto-regressive models in FRM part 1, not only in VRM but also in QTA, right? So these can be used to link default rates to prior year values or economic indicators, macroeconomic indicators. So that way, the model reflects the business cycle dynamics driving credit losses. And category correlation modeling. We can extend the framework across multiple categories, across multiple sectors. Okay, industries, geographies, or even rating classes. Okay, they show distinct but correlated default behavior. So each category may uh, have its own default pattern but still respond to common economic shocks. Now, using regression models, we can model how each sector's default rate reacts to these common economic factors. Okay, so this will preserve realism, but it will also maintain some analytical simplicity. Fine. So to summarize, credit risk plus models, correlation through uncertainty in default rates. Okay, and it produces a realistic skewed loss distribution to compute VAR. And by adding time series and category level modeling, we can make credit risk plus responsive to economic cycles. Okay, this will, you can say, bridge the a gap between actuarial simplicity and modern credit analytics. Now let us look at how default rate uncertainty affects the value at risk, okay, or VAR in credit risk plus. So this slide will show a very simple but a powerful example regarding what happens when the expected number of defaults is 4. So this is the assumption, but the uncertainty across that rate increases. So let's discuss. Okay, so this is the data that we are having. We are varying sigma, okay, from 0 to 10, and we are seeing the effect on the number of defaults. So when the standard deviation of the default rate sigma is 0, since we are assuming that the default rate itself is uncertain, so obviously there will be some standard deviation of the default rate. So if it is 0, it means that if there is no uncertainty, the model is assuming that the default rate is constant and known exactly. Okay, so in this case, the defaults will be assumed to occur independently, and the 99.9% VAR, if you see, comes out to be 11. These are the respective percentages for the number of defaults. Okay, and of course you can see the highest percentage will be for number of defaults being 4, because that is the expectation. So obviously the highest probability for will be for this default only, but the 99.9 percentile or the 99.9% VAR, which means that the number of defaults we would expect in, say, 1 in 1,000 worst case here is 11 defaults. Now, if you increase, say, sigma from, say, sigma 0.1, then 0.5, then up to 1, okay, what you are seeing? You are seeing that the 99.9% VAR, it actually starts to rise from 11 defaults to 13 till 1, and then to 17 if sigma is equal to 2.0. Now, what if sigma is high, say 5 or 10? Okay, so when uncertainty becomes very large, you can see that extreme events become much more probable, even though the expected number of defaults is still 4. The 99.9% VAR for the case where sigma equal to 10, it jumps to 98 defaults. Okay, so you can see that's almost from 11 to 98, almost a 10-fold increase, purely due to uncertainty in the default rate. Not because the average risk changed, just because there is uncertainty. So message is quite clear from this slide. Uncertainty in default rates, it is just not widening the range of possible outcomes, it is also amplifying the tail risk and therefore the VR. Okay. Now, this entire data of 99.9% VR, if we plot, if we visualize the same result in the previous slide, okay, it gives you a more clear picture. So on the x-axis, we have the standard deviation of the default rate or sigma. And on the y-axis, we have 99.9% VR, which is expressed as the number of defaults. So how to interpret this? Okay, as you can see, when sigma is near 0, VR is stable. Say this is around 11 defaults, as we saw in the previous slide. But as uncertainty is increasing, okay, especially for sigma equal to 10, the VAR shoots up exponentially. Okay, 10 times higher. So this perfectly illustrates the credit risk plus intuition that uncertainty in the default rate translates into correlated defaults and a positively skewed loss distribution, which is why real portfolios, they actually suffer far greater losses than average default rate would suggest. Okay. So if you want to summarize the most important idea behind credit risk plus, you can summarize from these two slides only, this one and the previous one. Okay. So when there is no uncertainty, defaults are independent, tail losses are mild. If uncertainty is increasing, correlation emerges and the loss distribution develops a fat tail. And that's why credit risk plus explicitly models default rate uncertainty. Okay, it makes the model more realistic for stress testing as well as VAR computation. Next, let's shift from credit risk plus to CreditMetrics, a model which was developed by JP Morgan in the same year, 1997. Now, while credit risk plus focused only on default events, CreditMetrics takes a much broader view. It also includes credit rating changes that affect the values of credit exposures, like rating downgrades, etc. They are also incorporated. Okay, so first, of course, we move from away from default only models and we look beyond them. CreditMetrics recognizes that credit losses just don't come from defaults. Okay, even if a borrower does not default, a rating downgrade, it will increase the credit spread and it will lower the bond's market value. So this drop in value also is a loss. It represents an economic loss. Okay, a loss that traditional default only models like Credit Plus would miss. Now, second, rating transition matrices form the foundation of CreditMetrics also. Okay, we discussed that rating transition matrix is very, very important in the Vasicek model as well. But even for CreditMetrics, rating transition matrices are very, very important. Okay, so each borrower's future credit state, whether it is say upgraded or downgraded or defaults, it is actually derived from internal or external ratings again by transition probabilities using that matrix. Okay. And Monte Carlo simulation is used to estimate each counterparty's end of year credit ratings and of course by that extension the portfolio losses. Okay, so at the end of each simulation all the exposures are revalued based on their new credit spreads or default recoveries, which will produce the distribution of portfolio credit value, and of course VR can be computed from that. Okay, now as I said, CreditMetrics uses Monte Carlo simulation to link rating transitions and portfolio losses. So it provides a complete portfolio level view of credit VAR. So what are the steps? Step one, we simulate the correlated rating changes. Okay, so we simulate correlated rating changes for all borrowers using a Gaussian copula. And the correlation structure is actually derived from equity returns, since firms that move together in the market often share similar credit dynamics. And it is a very good approximation. Then step two, determine non-default losses. For borrowers that don't default, we revalue their exposures based on new credit spreads tied to their ratings. And the resulting change in market value will represent either a credit loss or a gain. Then we calculate default losses. After non-default, we calculate default losses. For exposures that do default, we calculate the losses as exposure multiplied by 1 minus recovery rate. Again, the same formula that we have been doing from FRM part 1 only. Okay, and it has been used in FRM part 2 multiple times. The recovery rate is typically drawn from empirical or historical data. And then finally, we sum up all losses across the portfolio for each trial. Then we repeat the simulation many times to get the portfolio loss distribution. And from this, We compute the value at risk as well as expected shortfall, which captures the extreme portfolio loss scenarios. Okay, let's now move on to an important refinement in credit metrics framework. How do we handle credit spread term structures? Now, assumptions about how spreads evolve over a 1 year time horizon can have a major impact on portfolio VAR. So the way these models, we model these spreads determines how accurately our risk measures reflect the reality of the markets. Okay. So the first and most straightforward approach is a simple assumption, sometimes called as the current market spread approach. So here we assume that the current market spread curve for each rating applies uniformly. Okay. And we simply shift it according to any rate change. So it's quite easy to apply. And that's why it is often used in practice. But it ignores broader systematic market shifts. Okay, it assumes spreads move independently of each other, which can lead to, again, a significant underestimation of portfolio risk, especially during the periods of stress when spreads across the board tend to widen together. To improve on that, CreditMetrics introduced an enhanced assumption, the spread index model. So here, uh, instead of treating each rating in isolation, we introduce a market-wide credit spread index that follows its own probability distribution. Okay, each individual spread is assumed to co-move with the index, which means that when the market spread index widens or tightens, the spread for all ratings move in a correlated way. And this captures the real world behavior which we see during credit cycles. Spreads widen together during the crisis. So you can draw an analogy between, systematic risk and a market factor which we discussed in FRM part 1, where what we are seeing that there is a index, a credit spread index, and all the spreads are co-moving with this index. And the spreads will widen together during crisis and tighten together during expansions, while of course still retaining category specific differences. Okay. So in summary, while the simple assumption gives us convenience and speed, the enhanced model adds a lot of realism as well as interdependence. And of course, this leads to more accurate estimation of credit VAR. Okay, this slide shows how CreditMetrics extends its framework to handle derivative exposures using the credit valuation adjustment or CVA. Okay, so in these cases, exposure changes over time. So we need to account for time varying exposures, time varying default probabilities, and rating driven credit losses. So the first step is to divide the exposure horizon into several intervals. Okay, say n intervals from today until the final maturity of the transaction. Now, at the midpoint of each interval, we estimate the expected exposure after accounting for collateral as well as netting arrangements. Then step 2, default probability term structure and CVA based loss formula. So for each interval, we define the probability of default, let's say QI. Okay, and the present value of the exposure is, let's say, VI. And the recovery rate R is drawn from a empirical distribution. This gives us the foundation for computing the expected cost of default across time. So the expected cost or expected loss, you can say, of future because of future defaults from 1 year onwards is given by this formula. Okay, the sum over all future intervals, okay, as summation of 1 minus R QI VI. Now, if a counterparty's credit rating changes, their future default probabilities change as well, right? Say from QI to QI star. Now, the difference between the these two produces a change in expected loss, and that is your CVA driven credit loss. Okay. Then, how to interpret? So, if the credit rating improves, the new default probability obviously will be less than the old one because the credit rating has improved. This will give you a negative loss or a credit gain. And it's quite obvious because Qi star minus Qi will be less than zero. So it will give you a credit gain. But if the rating deteriorates, then Qi star is expected to exceed Qi, which will lead to a positive credit loss. Okay. And if an actual default occurs during year one, we directly calculate the loss as EAD multiplied by 1 minus the recovery rate. Okay. So this extension, okay, let's credit metrics handle derivatives and time dependent exposures also using the same consistent credit framework. Okay. So by integrating this CVA into the simulation process, CreditMetrics actually unifies credit migration risk, default risk, and exposure evolution in one single structure. Okay, let's see how CreditMetrics captures correlations between different counterparties' credit quality movements. So the first step is recognizing that rating changes are not independent events. Okay, so the if any firm's credit weakens, others in the same sector or region often follow, right? Because we have discussed this multiple times because of shared market or macro factors. So to capture this interdependence, credit metrics uses a Gaussian copula. This copula allows us to model the joint probability distribution of rating transitions. So we can represent how changes in one firm's rating influences another firm's rating. Then the correlation setup. So how are these correlations actually set up? Credit metrics aligns credit correlations with equity return correlations, which are typically derived from factor models like CAPM or other factor frameworks. Okay, this approach gives a market-based measure of how firms' credit quality is moved together, which creates a consistent link between credit risk and market data. Once correlations are established, the next step is simulation. So Credit Metrics employs this Monte Carlo simulation process. In each trial, we generate a set of correlated random variables. You can say, sorry, correlated standard normal variables, say XA, XB, or X alpha, X beta like this, which represent the underlying credit factors for each company. And each of these variables is then mapped to a specific rating outcome through the inverse cumulative probabilities from the transition matrix. So this step converts the statistical draws into credit rating transitions. Now defaults occur in this framework when the simulated value exceeds a certain threshold. Okay, the inverse normal cutoff corresponding to a cumulative probability which will be high. Let's say a probability which will near 1. So a near certainty of default. Crossing that threshold effectively means that the firm has entered default territory in the simulation. And what are the implications for credit risk management? So the correlation model set allows for a dynamic portfolio level assessment, capturing how the credit health of one entity can affect another entity, and it captures the interconnected movements in that way. It becomes a very powerful input, okay, for setting risk limits, managing exposures, and allocating capital more effectively. So in short, you can say it brings the interconnected nature of credit risk into a more of a quantitative focus. Okay, something which is very important for active credit portfolio management. Okay, to illustrate the credit metrics correlation model example, I have reproduced the same rating transition matrix which we were seeing earlier. So we don't have to go many slides back to check the data. So we'll just do it in these two subsequent slides. Okay, so this is the example. Suppose we are modeling two firms. One is A-rated firm and the other is B-rated firm with a correlation of, let's say, 0.2 between their equity return. So for each simulation trial, we draw two correlated standard normal variables, XA, XB. These random draws represent the systematic market effect and idiosyncratic noise for each firm. Or you can say they represent the credit quality shocks for each firm over 1 year. Okay, reflecting the changes in ratings for the A-rated and B-rated companies respectively. Now, just one thing I just want to highlight over here, although not very important, but when I said that, we are having a correlation of zero point 0.2, so we are drawing two correlated standard normal variables XA and XB. And in the curriculum, it was just mentioned that we draw two correlated standard normal variables XA and XB with a correlation of zero point 0.2. That is actually not possible directly. It has to be done indirectly. That mathematical part was missed. So technically, these X values are not done directly. We first draw, you can say, two intermediate, or you can call them auxiliary variables. Okay, ZA, ZB, which are then transformed into XA and XB to introduce the required correlation. Okay, so the mathematical transformation is not part of the course, so I won't go into it. It's actually quite simple, but still not part of the course. But it's good to remember that it just ensures that this XA and XB have exactly the desired correlation of rho is equal to zero point 0.2. Okay. The next step is to map each simulated value to a credit rating outcome. And again, this is done via this credit transition, this rating transition matrix. Okay. So, to use the probabilities that we have seen earlier in a simulation, we will convert them into cumulative probabilities. And then we'll translate them into standard normal cutoffs using the inverse of the normal CDF function, n inverse, if you remember. So I'll just give you the entire set of figures over here, along with the changes that you can see for both the firms together. Okay, and then we'll analyze one by one. So for the A-rated firm, if you see the cumulative probabilities for the A-rated firm, it has a 0.03% chance. Let's go back. For an A-rated firm, it has a 0.03% chance of being upgraded to AAA. Okay. So I'll just write. So for an A-rated firm to AAA, the chance is 0.03% or 0.0003. Okay. Now, if you take n inverse of this 0.0003, you'll actually get this negative 3.3416. Okay. Next, you see what is the, of course, this is the best outcome. Okay. And then we go to the next best outcome, which is being upgraded to AA. So for an A-rated firm, the probability of being upgraded to AA is 1.67%, right? Now, if you add 1.67 and 0.03, if you add 1.67% and 0.03%, you get 1.7%. Okay? 1.7% or 0.017. So I'll just write cumulative probabilities of both, say, A to AAA as well as A to AA. If we add them together, you get 0.03% plus 1.67%, which gives us 1.7%. Sorry, which is equal to 0.0017. Now, if you take n inverse of 0.0017, you actually get negative 2.1201, or this number. And that is why if XA is between negative 3.3416, so if XA is less than negative 3.3416, then directly to AAA. But if XA is between these two values, negative 3.3416 and negative 2.121, so between these values means between these two cumulative probabilities, this one and this one. So obviously between these two cumulative probabilities, you have a region occupying 1.67% of space. And since the probability of A being upgraded to double A is 1.67%. That is why if XA is between negative 3.3416 and negative 2.1201, it means that we are pointing to a probability of 1.67%, which means the probability of A being upgraded to double A. Okay, so same idea has been used across all the transitions, and for default, XA has to be greater than 3.2905 because the probability of default actually, although in this case it has been approximated only up to two decimal places, is actually 0.0005. Okay, so 0.05%. Okay, and in that case, the cumulative probability, if you add from the left to the right, you will get actually 0.995, because if default is on the right of 0.0005, then everything on the left of 0.0005 is not default, right? So the cumulative probability corresponding to that is 0.995, which is 1 minus 0.0005. So if you do that, you'll get 3.2905. Again, I'm not writing this, the default part also, because the logic is same. The same logic that we have applied for the first two continues up till the default transition. Okay. Similarly, the same idea has been extended for B-rated firm also. Okay. Now, you can see that the default thresholds, of course, are different. Okay, without any doubt, because for B-rated firm, the chances of default will be higher. Okay, and that is why you can see the chances of default are clearly reflected in XB being greater than a smaller value than 3.29, because 1.7744 is much smaller than 3.2905. Okay, so default is easier for this as compared to this. Okay, if you draw from a standard normal distribution, and even if you transform after that, drawing from a standard normal distribution and getting this has a very low chance, okay, of only 0.0005, but this has a higher chance of approximately, if you see the B-rated firm, approximately 3.81%. Okay, so this is the idea that CreditMetrics uses. Now, because XA and XB, they were correlated with the correlation was 0.2, they don't move independently. A sharp fall in XA will make it more likely that XB will also fall. And that is where that transformation which I was talking about, because if they were drawn independently from the standard normal distributions, then what kind of correlation would be there? Nothing. They are independent draws. But once they are drawn independently and then the transformation is applied, it ensures that the correlation is 0.2. So if by chance XA is a very high number, let's say XA falls in this range or in this range. Okay, let's say XA falls in the range where A is defaulting. Then since the two firms are having a correlation, it means that the chances of XB exceeding 1.7744 will also become a bit higher. Of course, as the correlation increases, that chance will become even more high. Okay, so by repeatedly simulating many such correlated draws, CreditMetrics generates a full joint distribution of rating transitions. And from this, we can compute the portfolio loss distribution as well as credit VaR. Okay, so the main idea is that the model preserves the marginal default probabilities from the previous this rating transition matrix. Okay, that is the main idea, that this marginal default probabilities is preserved, but it still injects a realistic dependency through the correlation parameter rho. Okay, so what we saw, the copula maps historical credit transitions into a correlated normal space, you can say, or a bivariate normal distribution, that also you can call it. Okay, each simulated draw represents a potential market scenario, and the dependency structure, it ensures that when one firm is suffering, okay, others are statistically more likely to suffer as well, just like we observe in the real markets. Okay, it is interesting to note that although credit metrics and credit risk plus appear quite different in structure, they can actually produce theoretically equivalent total losses, provided both start with the same assumptions about the default probabilities, recovery rates, as well as the discounting process and the rates. The key difference is when the losses are recognized. Okay. So in the credit risk plus model, losses are recognized only at the moment of default. Okay. So it treats the credit events as binary, either default or no loss. So as long as the borrower has not defaulted, no loss is recorded, even though the credit quality has deteriorated. It is simpler, but it offers a potentially delayed recognition of loss. By contrast, CreditMetrics recognizes losses continuously, both at downgrades and at default. It revalues the exposures as credit quality worsens. So even before an actual default, the portfolio reflects the economic loss from rating deterioration. This makes it better suited for active risk management and early warning purposes. So we can take the difference actually. If you see the fundamental difference, it affects capital planning, risk reporting, and portfolio management strategies significantly. Okay, so let's see an example. Let's see a simple example with a loan which started from say A. Okay, it starts out rated A. Now in year one, if suppose the borrower is downgraded from A to triple B. Now under credit metrics, a revaluation loss is recognized immediately. And under credit risk plus, no loss is recognized yet. Okay. Year two, there's another downgrade from triple B to B. Credit metrics again recognizes an additional revaluation loss, while credit risk plus still records nothing. In year three, the borrower defaults. Now, credit metrics, it records the final loss from default, okay, from that default event, while credit risk plus recognizes the entire cumulative loss only at this point. Okay, so theoretically, if if both models use consistent assumptions, the total loss recognized by credit metrics or the sum of revaluation losses in years 1, 2, and 3, it should equal to the single default loss recognized by credit plus in year 3. It is simply a matter of timing. So in both cases, the present value of losses over the full horizon has to be identical. Again, this is very important. Assuming consistent discount rates and recovery assumptions. In the beginning only we said this. If the assumptions are same regarding default probabilities, recovery rates, discounting, then the models will produce actually theoretically equivalent total losses. Okay, let us very quickly compare the three models. Okay, and we'll not discuss this in detail because all the points we've already discussed. So we'll just quickly compare them. We'll start with the Vasicek model. The implementation is simple, regulators accept it, but the problems are that it underestimates tail risk and the cases where correlation breaks down in extreme circumstances. Then Credit Risk Plus is computationally efficient for large portfolios but ignores mark-to-market changes from downgrades. Credit Metrics is comprehensive, captures all credit changes, but it is data intensive and highly computationally demanding. Now, when we move to the trading book, the focus shifts from default driven losses to mark to market changes in the value of credit sensitive products. Okay, these includes bonds, credit derivatives, structured notes, all those instruments whose prices move with credit spreads. So here the primary driver of value is not just default risk, but also credit spread movements. So when we calculate value at risk or expected shortfall, we need to explicitly capture the potential changes in credit spreads or spread volatility. One commonly used method is the historical simulation approach. So here we collect historical data on credit spread changes, say over the last 500 trading days for every company in our portfolio. Each day is observed change becomes one simulation scenario. The first scenario uses day one spread changes, and the second uses day two. So it's quite similar. In fact, almost the same to the historical simulation approach that we have done in FRM part one to calculate VAR, right? So we simulated 500 scenarios for the next day, right? And there was a confusion. If you remember, we are not simulating the next 500 days. We are taking the previous 500 days, and only for the next day, we are generating 500 new scenarios based on the last 500 days. Okay, that is the idea. So from this, we can actually compute a 1 day 99% VAR, and then we can scale it up by multiplying it by root 10, which will give us the 10-day VAR. Okay. This approach is simple and uses actual market data, but it has some limitations. So two main limitations: you have survivorship bias. Say if a company never defaulted during the historical sample, the model effectively assumes that it can't default in the future, right? That will again lead to an underestimation of risk. Next, data gaps or data quality issues. So credit spreads are not always updated daily or available for all issuers. So the data set may be sparse or even sometimes noisy. And this will make it very difficult to produce accurate VAR estimates for diversified portfolios. Then you have credit metrics based approach. So to overcome these limitations, we can extend this credit metrics framework to estimate VAR directly. Again, you directly start with a 10-day rating transition matrix. You know how to build it, right? Shorter duration matrix, we take fractional roots, right? And it shows the probability that a company's rating changes from say A to triple B over a 10-day period, let's say. Then we use Monte Carlo simulation. In each simulation trial, we determine each company's new rating at the end of 10 days using the rating transition matrix to decide whether it stays the same, gets downgraded, or defaults. And alongside the rating change, we also sample credit spread change from a probability distribution which corresponds to the company's final rating. So this way, both the credit rating, the rating movement and the spread adjustments, they are captured together. Now, once these simulated changes are applied, we can now calculate the new portfolio value after 10 days for each trial under all scenarios. Okay, we have to repeat this across thousands of scenarios. It will give us a distribution of portfolio value changes, okay, from which we can compute both VAR as well as expected shortfall. Okay, so in short, this method is simpler, but it may underestimate the risk because of these two biases. Credit metrics based Monte Carlo, it provides, you can say, a richer or even a forward-looking framework. It integrates the rating migration, spread volatility, as well as portfolio valuation, making it much more consistent with how credit-sensitive instruments they behave in practice. Now, once we have estimated the portfolio VAR and the ES, the next important step is to introduce credit correlation, because in reality, credit movements are not independent. We have seen this multiple times today, right? And we have the approaches that we have discussed, they all deal with the correlation in a different way. So when we are talking about the trading book, there are two main ways to do this. The first one is, of course, the Gaussian copula model. Okay, it introduces dependence between credit rating transitions of different counterparties, different issuers. So essentially, you can say it allows us to model situations where downgrades or upgrade occur together, correlated upgrades and downgrades. The second approach involves modeling of the correlation of credit spread changes. So here we assume that spread movements are either they are perfectly or almost perfectly correlated across different rating categories. For example, if the spreads of A-rated firms widen due to any market shock, then the lower rated spreads like triple B spreads, double B spreads, they will likely widen as well. Okay. Incorporating such correlation effects, it makes the VAR estimation far more realistic and ensures that Portfolio level risks account for the fact that credit events rarely happen in isolation. So, what is the key takeaway? Credit spread VAR is bridging, because when we talk about trading book, in a sense, we are directly concerned with market risk as well. So credit spread VAR, it is actually bridging both the risks. In the first slide also we discussed this, right? And credit metrics, it is providing the structure which is needed to do this in a very statistically coherent manner. Okay, let's take an example for this credit spread risk in the trading book. So consider a company that possesses a single 3-year zero coupon bond. The current status, the rating is B rated bond. Okay, it's a single 3-year zero coupon bond with $1,000 face value. Okay, the risk-free rate stands at 4%. Okay, and the current credit spread is 300 basis points or 3%. Okay, this is the premium for B rating. So what is the total bond yield over here? Risk-free rate is 4%, spread is 3%. Total bond yield is how much? 7%, sum of 4% and 3% with annual compounding. So if you calculate the current price of the bond using a 7% yield, you will actually get 816.30. If you want, you can just do this calculation. 1000 divided by 1 plus 0.07 raised to the power 3. Simple annual compounding we are assuming. You will get 816.3. Over the next month, see, currently we discussed the bond is rated as B. So over the next month, if we want to do a scenario analysis, let's say over the next month, the bond has a 0.1 probability of defaulting. It has a 0.6% probability of getting downgraded to CCC. It has a 98.1% chance of maintaining the same. These are again hypothetical numbers we have taken. We have not taken the probability from the rating transition matrices. Okay. Okay. And there is a 0.9% probability of getting upgraded. Now, of course, if the bond defaults, then the value, the recovery value has to be assumed either to be zero or something else. So in this case, we are assuming it to be $400. For each rating change scenario, we are assuming 3 potential credit spreads, which are assumed to be equally likely. Okay. So for example, for this part, if the bond is upgraded from say B to double B, then 3 possible credit spreads the bond can take. Either it can be 180, 200 or 220 basis points. Similarly, for B, you have 3 potential credit spreads, and for CCC, you have 3 potential credit spreads. Okay, let's write the numbers into the Excel sheet along with the scenarios and the sub scenarios. And let's try and calculate the bond value after 1 month and the corresponding loss amount. So we have a $1,000 face value bond with a maturity currently of 3 years, right? The risk-free rate is given as 4% and the current bond spread was given as 300 basis points or 3%. So obviously the applicable discount rate or the yield you can say will be equal to 4% plus 3%, which is 7%. And we found out the current bond value by taking 1000 and of course dividing it by 1 plus 7% whole raised to the power 3 years, because currently 3 years are left till maturity. So we get 806.30 as the current value of the bond with a 3-year maturity. Now, of course, after 1 month, if you want to calculate the number of years which will be left to maturity, so we need to consider that, just before 1 month, 36 months, that is 3 years were remaining till maturity. So 3 years is equal to 36 months. So now since 1 month has passed, so now it will be 35 months. So in terms of years, it will be 35 divided by 12, which is equal to approximately 2.92 years are left now after 1 month. Now, these are the scenarios which are given to us. This is the worst case scenario, 0.1% probability of default. Then the second worst scenario, 0.6% probability of downgrade to CCC, then 98.1% for B and 0.9% for upgrade to double B. Now, even under these scenarios, we have certain sub scenarios. So, for example, of course, for downgrade, this for default, there is no sub scenario. So, we can directly write the probability of default as 0.1%. But it was given that for every rating change, there are three scenarios or sub scenarios which are equally likely, which have different spreads. So basically, if you have a 0.6% probability of downgrade to triple C, then each of these three scenarios with different spreads, since they are equally likely, they will have a probability of 0.6% by 3. Okay, so since all three of them will use the same B12, that is 0.6%, I'll keep this as constant and I'll divide it by 3. Okay, so I get 0.2% for this scenario. And of course, by that extension, 0.2% for these two sub scenarios as well. Now, as far as the rating migration, no rating migration is concerned, basically same rating as B. The probability for that event is 98.1%. So obviously under this scenario, the probability of these three sub scenarios with varying level of spreads will be equal to this 98.1%. Of course, we'll press F4 to make it constant, divided by 3. So I get 32.7%. Similarly, for these two scenarios also, it's 32.7%. And finally, for upgrade to double B, the probability will be equal to 0.9% by 3, which is 0.3% for all these three sub scenarios. Cumulative probability. Now these two columns H and column I. Column H and column I have added uh, because in the GARP example only the VAR interpretation was given based on this column probability only. But if you want to appreciate the VAR at a certain confidence level, I think it will be really helpful if we have column H and I as well. So this is basically something along the same lines that we have done in FRM part 1, where we used to visualize, we used to draw diagrams and then we used to land up in a certain confidence level zone between two consecutive confidence levels, and then we used to find out a particular VAR. So we'll do the same analysis, okay, but of course we'll copy these numbers in the PPT when we get the final loss values, and then we'll do that kind of analysis. So these two columns H and column I, you'll be able to appreciate better when we do the VAR analysis. So of course, for cumulative probability, we know that for the first scenario, the cumulative probability will be same. For the second scenario onwards, it will be the current probability plus the previous cumulative probability. Okay, so basically we are summing up all the probabilities like this, and then we get the cumulative probabilities. Now, cumulative confidence level will be equal to 1 minus the cumulative probability. Okay, so basically, since this is the worst scenario, okay, if you translate into a confidence level, it will become 99.9%, which means 99.9% of the time, the loss will be less than or equal to this much amount. We'll see that analysis, don't worry. So we get all the cumulative confidence levels like this. Now, if we want to calculate the bond value, we need the applicable discount rate. Now, for the first scenario, default, we don't need the applicable discount rate because we already have the value. It is given to us that if the bond defaults, the value drops down to $400. Okay. So in this case, we just write 400 and we just don't care about the applicable discount rate. For the second, or you can say this was the worst scenario, this is the second worst scenario. So for the second worst scenario, the spread has become 700 basis points. So the applicable discount rate will be equal to 4%, the risk-free rate, plus this 700 basis points or 7%. Now, since this 4 has already been expressed in percentage, when you take it in the formula, it will actually automatically convert it into decimal. So it will be 0.04. So we have to also convert 700 into 0.07, right? So obviously first we'll convert it into percentage. What we have to do? We have to divide by 100. 700 divided by 100 becomes 7%. But then again 7% divided by 100 again will become 0.07. So in effect we are dividing by 100 twice. So basically we are dividing it by 10,000 to get 0.07. So E3 divided by 10,000. Also, of course, I have to be careful that for this B1, since I'm going to use the same risk-free rate in every single entry after this, I'll just press a constant of F4 over here so that I just fix it. Okay. So yeah, this is 11%, and correspondingly all the applicable discount rates are calculated like this. Now let us come to bond value. So bond value will be simply equal to the face value, which is 1000, divided by 1 plus divided by 1 plus the applicable discount rate raised to the power the time to maturity now. So after 1 month, we know that the time to maturity is 2.92 years. So this will be the time used over here. And again, we have to be very careful that this will be the same time to maturity for each of the other scenarios and sub scenarios. Don't get confused into believing that for every scenario there will be a different time to maturity. No, all these scenarios and sub scenarios are applicable for the next month only. So press F4 to fix it and then drag across all the entries so that you can get all the different bond values. Now, what about the loss? Loss is nothing but the initial bond value minus the final bond value. If the bond value has decreased, of course there will be a loss. So it means that this loss will be equal to the previous value 816.3 minus the current value of 400. So this is your loss. This is the worst case loss that we are having. And again, I'll have to press I think F4 over here because I want to keep it fixed, because 816.3 is actually the bond value, the current bond value against which all the next month bond values are compared. Okay, so I'll just drag it and we'll get all the loss values. Now let us do the VAR analysis. Let us just copy everything, all this, the entries of this table in the PPT slide, and let us do the VAR analysis. Okay, so these are the numbers which we have taken directly from the Excel. Okay, and we'll just do VAR analysis now. So as you can see, at a cumulative confidence level of 99.9%, the loss is $416.3. Okay, so let's consider the case when you have the confidence level for VAR greater than 99.9%. So which means any VAR which is measured at a confidence level above 99.9%, how much should that VAR be? See, we need to understand this, that when we talk about 99.9% VAR, okay, we are talking about 0.1% of the worst outcomes. So this is what we have done. We start from the worst outcome and then the second worst, third worst, like that. Okay, so what is the outcome which will not be exceeded in 0.1% of the cases? This outcome 416.3, and that is why the VAR at any confidence level above 99.9% is 416.3. Okay, now let us look at the second case when the confidence level, the cumulative confidence level, is between 99.7 and 99.9. Now this, if you remember FRM part 1, how we used to do it, we used to draw a line, we used to visualize this properly, that as soon as you cross the 99.7% zone, you are actually in the next zone where you can calculate the VAR for any confidence level above 99.7. So that's the same idea that we'll be using over here. So between 99.7% and 99.9% confidence for any confidence level, if you measure the VAR, you'll get it as 78.72. Okay, so that is the idea. Now, what if I ask you the VAR at 99% confidence? Okay, so we know that this is the worst outcome. Okay, the worst outcome, the loss in the event of default. This reflects the second worst outcome. You can say the worst non-default scenario. Okay, a downgrade to CCC at the highest spread. Now, what if I ask you, okay, what will be the 99% VAR? What should your answer be? Now, again, you will use the same logic about which I was just discussing from FRM part 1, the way we visualized it. So 99% is between which two cumulative confidence levels, 66.6 and 99.3. So as soon as you breach 66.6%, you are in that zone. Okay, so that is why the 99% VAR will be actually equal to 3.17, because any VAR with a confidence level between 66.6% and 99.3 will be same. So of course, since 99% is between these two percentage amounts, that is why the 99% VAR is $3.17. Okay, so you can see that there is a dramatic change. Okay, with a slight change of percentage. Okay, there is a dramatic change which is actually expected, because these tail events have to be assumed to be more extreme. That is how the scenarios have to be constructed, and in reality, this is what happens. So in the next slide, we'll just visualize this dramatic impact. Okay, so here we visualize how the losses vary across confidence levels when calculating value at risk for that credit sensitive bond that we were discussing. So at 99.9% confidence level, we saw that the VAR is around $416, which represents a default event. You can say the most extreme tail loss scenario. At 99.7%, the VAR drops sharply to about $79, $79.80 only. Okay, of course, this was the worst non-default downgrade. Okay, which is in this case a move to triple C rating at the widest credit spread of 700 basis points. And by the time we reach 99% confidence level, VAR is only about say 3 point something dollars, which reflects relatively small losses from spread fluctuations within the same rating category. Okay, so you can see this stark contrast, okay, this dramatic impact across the three bars. It clearly highlights how credit spread VAR is heavily driven by tail risk. Okay, that is rare, but severe events like defaults and deep downgrades, okay, they are actually the main drivers of credit VAR. Okay, so this graph itself is a very powerful reminder that most of the portfolio's credit risk lies in the extreme left tail of the distribution. Okay, that's it for this lecture. We can just take a brief pause and we can just try and reflect, consolidate what we have covered today. So we started by uh, distinguishing market VAR from credit VAR. Okay, then we build the mechanics of how credit VAR is calculated, using rating transition matrices. Then we discussed the Vasicek model, credit risk plus, CreditMetrics model. Okay, and we saw how each of the models offer a different lens on how to model the default probabilities. Correlation was a very important factor, and how these models handle correlation in a very different way. Then we extended our discussion to derivatives exposures, also to trading book also. Okay, which introduced credit spread risk, and we saw that it is the missing bridge between market risk and credit risk when we discuss trading book. So overall, you can say that credit risk modeling is not just about predicting defaults. Okay, it is actually about quantifying how credit quality evolves, how it correlates across exposures, and how those shifts translate into portfolio level losses. Okay, so all the best for your exam. Thank you very much for your patience. If you have any queries, please do not hesitate to reach out to us. Thank you so much. Namaste.